Thanks for having me.
6.6%. It looks like the market was looking for a rise of about 7%, down from the 7.3 we saw in March. So, again, inflation numbers coming in softer than expected.
Yes, Stephen, and that's very good news because we know that the fear is that what's happening on the producer side of the economy will eventually feed through to what consumers have to pay on the shelf, with implications for monetary policy, with implication for how much cash the average consumer has in his pocket. So I'm very happy with this figure.
What does the feed through from PPI to CPI? Because we had a change in the basket a year or so ago, and that has lessened the correlation. Do you still see a feed through though?
I think you're right. I think in recent times we have seen less of a correlation. I think, however, over a sustained period, if we observe the PPI going up, then eventually that will feed through onto the consumer side. I think what's also important is, for me, this figure illustrates a little bit that there is still an amount of excess capacity in the economy. So things on the producer side are not, prices are not rising as fast as we thought. And it's indicative that the economy is still recovering at a fairly subdued rate.
How about the rand and commodity prices during the month in April? Do you think we maybe underestimated the strength that came back through to the rand and overestimated where commodity prices were going?
Well, I think the rand was helpful in this. However, if one looks at the inflation of imported goods in April, it came in at 9%. And we know that about 40% of our imports come from Asia. Now, Asia has been experiencing slightly higher inflation than what we have been experiencing here in South Africa. And that's what led to that higher level of inflation as far as imported goods is concerned. So yes, there is some buffet from a stronger rand, but there's factors beyond our control that would feed into the figure as well.
Well, Sheshi, you came in a couple of weeks ago when we had that Monetary Policy Committee. We chatted about rates and we listened to Jill Marcus talking about the inflation risks out there and also raising their inflation expectations quite dramatically, up to 6% by the end of the year, 6.3% in the first quarter of next year. The week after that, we had a CPI reading softer than expected at 4.2%. PPI also a little bit softer. Do you think we're overestimating where inflation's going in this economy, or do you think we're still going to get a big scare?
I think the role of the Reserve Bank is to be extremely cautious. I think the role of the Reserve Bank is to look at what could be a worst case scenario. They need to anchor inflation expectations. They need to be seen to be vigilant in the wake of any upside risk to the inflation outlook. And I think that's partly what was being communicated. However, if one reads the recent statement that's just come out, clearly the Reserve Bank is saying we know that the pressures are from the supply side, and even that breach, that potential breach, is one that will be temporary. Currently on the projectile that I see us on, I am hopeful that actually the inflation expectation of the Reserve Bank is higher than what we will actually end up with in the year 2011.
Well, what's your worst case scenario? Do you think we will reach that 6.3%, or do you think we might stay within target at the beginning of next year?
I'm hopeful that we'll stay within target. I think that on the domestic front, the consumer is still under strain, so there's no demand side pressures. Clearly what's happening in as far as administered prices is of great concern. So even on the figures that we've seen today as far as PPI is concerned, electricity increased in excess of 20%. So those are the type of things that one has concern about. However, even with that increase, PPI still overall increased only 6.6%. So I am hopeful that given the subdued environment globally now, with the renewed events in Europe, things in China and India seem to be cooling down a little bit. The global environment seems to be dampening somewhat, and I think that will have a softening impact on our inflation.
Of course, the rand's also key here, and we've seen that rand trending up above 7 rand over the past couple of days. Some saying we could see more weakness coming through. Your expectations for the rand?
Stephen, I think that the rand will always react to any temporary increase in uncertainty. So when there's renewed fears around the sovereign debt crisis in Europe, we see the rand's volatility increasing and any other such event. However, I think when we look at the rand fundamentally, we are in a country where fundamentally our macroeconomic management is far better than what obtains in much of the developed world. We are in a country where the growth rate is still higher than in much of the developed world. We are in a country where the prospects for positive interest rates are also better. As you know, interest rates in that part are close to zero. So I think looking at those factors, one would expect capital to still continue to flow in this direction. One would expect the search for yield, the search for return to still be pursued in emerging markets. So I would think that for the foreseeable future, the rand will still stay at fairly strong levels.
Have you changed your interest rate view since that MPC meeting? Have you brought it forward at all?
It's hard to say. We're in such a volatile environment, Stephen, but I think given what's happening globally at the moment, given there's more recent figures around inflation domestically, I am increasingly becoming of the view that we will not see a rate hike in 2011. We will see one next year. So that's my best bet at this moment.
And I like that view. And tell me, how about, you talked about inflation expectations, how about wage expectations? Because we've seen the National Union of Mine Workers this week coming out and asking for 14% increases for workers in the gold and coal sectors. And it looks like we are entering wage negotiation season with some pretty high demands despite inflation sitting at 4.2% at this stage. Do you think this could throw the cat among the pigeons?
Yes, I think whenever we enter into the season of negotiating wages, what is put on the table and what is demanded tend to have a fairly significant level of divergence. And I think what you've just described is testimony to that. However, the surveys of wage increases have shown that wage increases are moderating somewhat. We shouldn't really expect wage increases to be too high in an environment where unemployment is going up. There's a fair amount of excess capacity in our labor market. So I'm hopeful that the wage increases will be moderate and that we will be able to find some middle ground which doesn't put unnecessary pressure on inflation going forward.